What's up, everybody? Making another stock duck video. This is probably my favorite slide deck I've made, and it's going to describe an important concept called cost averaging. So let's get into it. One of my mentors, Dr. Khan, he doesn't even buy stocks, but he drew this parabola on a whiteboard one day when I was in my oncology training. He said, if you're trying to buy stocks, just remember you're trying to buy stocks in this area. The goal is to make the perfect buy at the exact lowest point, but it doesn't work that way. We don't want to buy it when it's at its highest on the way down, and we want the value to go up so that we can sell it and make money, right? So you want to buy at a relatively low point, but it's hard to know if you're here or here or here or here or here. But we just want to get it in here and sell it up there. So if you buy too early on the way down, that's your investment isn't off to a good start, and you got to do something to help yourself out. And so that's a concept called cost averaging. So I'll show you one of my first investments I ever made. One of my good friends, who is one of the most sophisticated, successful investors I know. We had some money in some 401ks that we had rolled over from a previous job. He said, Anthony, you got to buy this stock, ADMP. It's about $2 a share. It's worth $6 easily. And they had so much going for them. They had a big compounding company. They had a high dose naloxone product called Zimhigh. They had a product called epinephrine, or an epinephrine product for allergy. And the company was just worth so little relatively to its potential with a market cap. So this is around where I bought the stock. And as you can see, like the first year of owning this stock was miserable. And I actually, I was worried. Oh my gosh, I'm losing money. What did I get myself into? Their CEO is named Dennis Carlo, and I remember getting on Stock Twits and reading what other people had to say about him, and the nicest thing anybody called him was an ape. So there, if you look in Stock Twits, you'll see a lot of memes and cartoons with primates, throwing feces, and so everybody hated this company that had invested in it, and everybody hated the CEO. They made a lot of mistakes and just really could not execute their products. And there were people that bought this stock at $8, $9, $13, and that had lost a lot of money. So we're getting in here, and over time you can see of the life of the investment, our stock has lost price per share, and therefore we're losing money on the investment so far. But as my buddy would say, you only lose when you sell, or if you sell. And I would nervously text him all the time. I'm just learning stocks at this point. It's one of my first 3 holdings. I said, "Are we gonna get out of this alive? Are we gonna make money?" And he would always say, "Yes, F him." And he still says this to this day whenever we're down on a stock and I ask, should we buy more? This is the mentality you got to bring, and I'll show you why. So I made a table. This is not exactly, certainly not the exact points that I bought the stock at, and I just used $100 invested at a representative value. But I got into the stock at $2.11, and 2 months later, it's at $1.50. So we're down. 4 months later, it's at $1.15. In 1 year, the stock depreciated from $2.11 to 36 cents. And that came from shorting, came from strain balance sheet with low amounts of cash, and the stock was just attacked. And as time went by, the more mistakes they made, the rougher things were. The price per share and the market cap according to this price per share just became more dissociated from the intrinsic value of the company and its products. I think at its low point, this company was worth only about 100, or sorry, was only worth about 30 or 40 million, maybe even a little less actually. So, what did we do? Well, we averaged down our cost per share, and this is the hardest part for an investor to do. So we bought at 211, and I'm just giving representative proportions here. Let's say we bought 47 shares. When that stock price went to 151, we bought more. And for our same amount invested, we got more shares. And the average cost of the share came down. So as the stock price goes down, I kind of call this playing defense. By buying more as the stock price gets lower, you are lowering your average cost per share, and therefore making it easier to make money when the stock turns around. And I've never bought a stock that went to zero, never bought a stock that delisted. All these companies have enough quality and enough intellectual property that they don't go to zero. They may keep raising cash in exchange for creating new shares and dilute the price per share to the investor, or the stock may be shorted unfairly. But as times get rough and the stock price goes down, you can defend your investment by buying more shares as the price goes down. And believe it or not, this is exactly what's happening with your retirement account without even knowing it. Every single month, if you have a work-funded retirement account or a work-matched retirement account, when all they are doing is buying you shares of the same index fund over and over and over again, or while you're in a certain age group, they're buying one index fund, and if you get a little older, they may switch it to something a little more conservative. But they're repeatedly buying shares of an index fund for you. And let's say they're putting $200 away. If the price per share of your index fund goes down, when there was a mini stock market crash last March or April, the price of everything is reaching a relative low. And same thing happened with your retirement index fund, and all of your work related retirement fund was doing was you were just continuing to contribute the same amount and buying more shares, and so you were paying less per share. You're lowering your cost basis, and you're not thinking about it, but that's exactly what you're doing. And for whatever reason, as people buy individual stocks, they are afraid to do this, and they think, oh, it's going to go to zero, or I'm losing, and they'll either panic sell and realize the loss that they've made. In other words, maybe they sell here and they've lost over 50% of their investment. But what you really should be doing, if you like a stock at 211, you should and not too much has changed fundamentally about the company, you should like it at 36 cents. You should like it at 151. You should like it at 70 cents. You've already made a value assessment at one point in time, and you have to think of these lower prices per share as an opportunity. So, what's going on when I got into this stock here, and as the stock price was lower and lower and lower and stayed there for a while, I had to look at that as an opportunity. So, again, I ask my buddy, we can get out of this, are we going to make money? We're not going to lose it all, are we? We should buy more, right? He would always say, yes, F. And you can see that by doing that, when things turned around, and don't get me wrong, I was anxious to get out of this stock, but my first entrance into the stock was at 211. I sold everything at $1.10, but by averaging down, I got my average down to about 77 cents per share. So really, this ended up being a good investment. Sorry, my mic cut out, but really this ended up being a good investment. It's so counterintuitive because, by lowering that average price per share, when things went right for a short period of time, and I'm talking about this little peak below my cursor, and that price got up to 110 or so, I said, see ya, and was able to sell for 110 versus 70. That's about a 43% profit in 16 months. It wasn't pretty. It wasn't the best investment of life. It was actually one of the worst stocks we've ever picked, and it happened right after I started doing this. So, I thought, for the rest of my life, buying stocks was going to be this hard. It has not been, and we got into this stock before I started using the filters that I use now. So I'm using a lot more data now and a little more sophisticated, or a lot more sophisticated with when I'm choosing to buy. But everything I post on my Facebook, I'm really trying to help people get in here, and I'm using data to where things are super, super low, and I'm looking at metrics to help pick a bottom. I'm never going to bat 1,000 and getting you right at the very apex of this, but um, we're doing a lot better at picking a bottom. But when you're wrong, when you get in a little too early in the stock's descending, and before it makes some ascension upward, you have to have the attitude, I'm right. Because even if you picked a company that didn't really execute very well, and you average down your shares, eventually things get better, and you can make. I made money when this stock got up to only about half of the original price I bought it at. So that's something I wanted to show you is, even if you make a mistake or you don't buy the best stock, really, you can buy most any stock that won't go to zero. And if you can average down those shares, and I actually did this. I was actually more aggressive than this, but eventually, if you try and do this forever with limited funds, you'll run out. So, I just showed a strategy where you're doing the same amount at each level. But maybe you really feel like 57 cents has got to be the bottom. So we're going to put 500 here. At 36 cents, maybe you put 1,000. I mean, you can really lower that average price down. And again, it doesn't work forever. Not everybody has the kind of bankroll to do that. But I call this playing defense and lowering your average cost per share. If you're really risk averse, something I tell people is when you make your own account and you make that first purchase, and you really, really don't want to be down, use only a fourth of what you have to buy that first stock, and leave 3/4 in case you hit some sort of catastrophe and you need to average down. Budget for that accordingly. And again, the more and more I do this, the less I find myself having to do this. I just want to show people that you could make money even if the stock was poorly managed or depreciated quite a bit in value. I wanted to show you also another example of a time I really wished I averaged down, but I didn't. So this was a company called OCGN. My buddy suggested to me, said they make eye products. It's super cheap. Company sure wasn't worth a lot, and I thought I was getting a great deal. I got in at 70 or 80 cents, somewhere probably in this hump here. And that was not a good time, and the stock dropped, I think, as low as 24 cents. And I'm thinking in my head, this is a piece of junk. I don't want to chase this. There were things I liked better, so I never did average down, and it hit a low in the 20s. And I looked at this stock on my tracker and saw that I was down probably 60 or 70% at one point. And things turned around, and eventually I got back to even, to where I made my money back, sold it at break even, and I thought I was hot stuff for doing that. I made my money back on the worst stock I ever bought. But look what happened. The company, again, element of surprise here with these small biotech companies, decided they were going to go into vaccines. Stock skyrockets, hits about $3. So imagine if I would have bought more down here, 20 cents a share, 25, 30 cents a share, really got that average down. And then I'm making, 6, 8, 10 fold if I can sell at this point. So again, I sold at break even, felt fine about it. with some capital that sat stale for a while. Um, but I sold at break even and I was happy about it. But look what would have happened if I would have averaged down. So cost averaging extremely powerful. Your long-term investments through your retirement plan at work, if you have one, they're doing the same without you knowing it, and it's a necessary evil if to maximizing profits. And don't forget, if you have the mindset that you're right and this stock isn't going to zero, you'll beat you'll win the game, and don't ever be afraid to say F them.